Hello and welcome to the Mutual Fund Show. My name is Niraj Shah, and over the next 25 minutes, as we've stated, we'll talk about 2 or 3 key things that we thought were important to bring out. That aside, if you have any questions, try and send them on our social media platforms, and if they come on time, we can probably ask our experts to respond to them on the show, or maybe we can get them to respond to them later on social media. So use any of our social media handles or our website and try and post your queries if you have them. However, let's get in our guests today to talk about the 2 or 3 key things that we think are important at the current point of time. Suresh Sadagopan Johnson again, and Avinash Luthria Johnson, both of them need no introduction. They have been guests on the show before, and they're joining yet again. Gentlemen, both of you, thank you so much for joining in. Hope all is safe with both.
Thank you. Yes, thank you very much.
Great.
Hi Niraj, hi Suresh.
Yeah, great. Good, glad having you both. Okay, let's start off with the first thing, because yet again, I see on a lot of our Twitter platforms, a lot of questions that are posted to me on Twitter and through a lot of other social media platforms as well, that the conversation around with equity markets having, reached this 12,000 mark, that people are thinking of how to buy a bit of protection as well. Are there other options to do, because real estate is just out of favor? And is gold giving a chance? Now, this is not a personal finance show, and therefore our experts will not get into the merits and demerits of investing into gold or whether the price is good or not. But what I'll request my guest is to try and elaborate a bit on which form of mutual fund tool could be a good way to invest into. Suresh, I'll start off with you first. I mean, if you, of course, have a thought on whether it's a good time or no, be my guest.
Yeah. So as far as asset allocation is concerned, my view is that gold is a strategic asset, and it has a different profile as compared to other assets. So to that extent, an allocation into gold is always suggested by financial advisors, and I'm no exception to that. Now, when the gold was actually moving up significantly, a lot of people actually came into gold, and if you were to look at in the last few months, the amount of money that has been put into gold ETFs has been rather significant, and it has been rising. Now, since August, there has been a kind of a plateauing and fall in the gold prices. And because of that, there has been a rethink on the part of investors whether this is such a good idea or not. And because of that, the flows have ebbed, and probably in some cases, I also hear that there has been a withdrawal in terms of gold assets. So my larger point is that, different assets are going to perform at different points, and there can be multiple reasons for that. Gold is performing for all the reasons reasonably known to us already. So my point is, just because it has started falling, we really cannot assume that gold is not a good asset. In fact, if you look at a 10-year time frame, gold has performed better than the equity. I'm not saying that is a buying point in favor of gold, but I'm only saying that it's a different asset class, and we should consider buying this asset primarily in the form of a financial instrument. So that is what you wanted to know. ETF is definitely a preferred financial instrument as far as gold goes, but my preferred financial instrument would be sovereign gold bonds, simply because it tracks the price of gold, and at the same time, Government of India is also going to give you something like 2.5% if held. 2.5% for every year you're holding that bond. And one more very, very important attraction as far as sovereign gold bond is that if it is held to maturity, that is for a period of 8 years, the whole proceeds is tax-free. So it's very, very attractive to hold. If you want to invest in gold, probably sovereign gold bond is a good bet.
Okay. Avinash, any thoughts on the asset class itself, but what's the best way to do it? And I was talking to somebody in the markets who was telling me that it might not be a bad idea to look at gold funds, because gold mining companies, especially after Warren Buffett bought into one, might and if they indeed do well, so the gold funds might actually give you really good returns, more than gold ETF. Do you have any thoughts? Avinash, can you hear me? I think we've got Avinash on a slightly patchy line. We'll just try and get that going because we're working beautifully when the show started. Just losing a bit. Suresh, you just want to dwell on that as well. You mentioned that sovereign gold bonds are the best. What about gold funds? I mean, because there are a couple of them. Should people use them or avoid them?
Gold funds and gold bonds are actually two different things. Okay, like DSP used to have a world gold fund. I think one or two other people have a world gold funds. So this is basically tracking the performance of the company itself, not so much the gold. So if you want to invest in a gold mining company, so that's completely different from the gold. While I do understand that gold prices will have an effect on the performance of the company itself, but gold mining companies, they have different dynamics as compared to the physical gold prices. So if you really want to stick to gold as an asset class, and if you want to really only want to track the price of gold in reality, then I think you should stick with gold. If you want to be slightly more adventurous in the sense that you really want to also get riding on the company per se, along with the price of gold, then I think a world gold fund kind of bet will be fine.
Okay, Avinash, if I have your connection proper now, do you have any thoughts on the same topic? Okay, I think Avinash's connection. Yeah, Avinash, can you hear me?
Yeah, and sorry about the connection issue. And I could have missed your question earlier, but I'll just tell you what I'm thinking.
Yeah, please carry on.
So gold is a pretty hard asset to forecast. It's even harder than equity. People tend to think of gold as a very safe asset, but actually it's a very tough asset to forecast. If you go back in history from 1980, when it was at its peak, both in terms of the number, in terms of purchasing power at least, it then fell from 1980 to 2001 by about 6%. And in terms of purchasing power, it fell by about 83%. So it's a pretty significant fall. Even as of today, gold hasn't yet reached the purchasing power that it was in 1980. I mean, you'd imagine 40 years later, it's still not caught up with inflation and reached the purchasing power. So it's a very hard one to predict. I have personally never recommended gold to my clients for that reason. I have never not recommended, but I never recommended it. And my stance is generally that if your issue is that you don't trust the rupee and inflation in India, you're better off. You can't buy safe assets in the US, but what you can buy is you can buy the US S&P 500 index fund, and that's a better way to get exposure to a dollar asset, which is what people are trying to do with gold, without actually using gold. I know that's risky, but still, I think less risky than gold.
Okay, so viewers, I mean, at least the two experts that we have today are bordering on the side of definitely not using mutual funds for the gold route per se. Avinash believes you shouldn't invest in gold per se because there are other options available. Suresh believes that if you do want to invest in gold, use the sovereign gold bonds as the first port of call. Gold funds are not necessarily the best way to go out and invest, because viewers, just keep this mind in distinction, as Suresh explained. A gold fund, a world gold fund that is available, doesn't go up or down on the basis of the price of gold. It goes up and down on the basis of the underlying companies which form the NAV of that fund. And of course, an Indian fund is merely a mirror image of, or a fund of sorts, of a world fund. So just keep that at the back of your mind. Okay, so that's as far as gold goes. Now, the couple of other things that we did want to talk about, and I wonder how important and serious they are and how should people kind of think about them. So what we learned, of course, is that mutual funds and AIFs may come under the ambit of the new tax collected at source regime, which of course came into effect October 1st. Any thoughts on this, Suresh? How does this impact life?
Yeah, I mean, so this is, if it is a government fiat, there is not much we can do about it. But I'm just being thankful about this whole thing that it is only 0.1%. It is not. It could have been a much higher number there. So yeah, it does affect us, but I think we have to take the rough with the smooth, and we have to move on in life. So I mean, I have no specific comments on that.
Okay, Avinash, have you looked into it? I mean, the idea is not to try and, I mean, yes, of course, how big or small, I'm thinking Suresh is saying is not that great, but what's the net impact, if at all? Is there any way to assess that? Okay, Suresh, I mean, any way to assess the impact thereof? Sorry, I'm having Avinash on a slightly patchy line right now.
Yeah. So I mean, if you look at the impact, I mean, suppose we take a 1 lakh investment, the impact of that on one's investment will be something like 100 rupees. So would I like to have that 100 rupees back from the government in my kitty? The answer is yes. But yeah, I mean, government will make rules, and we'll have to follow those rules. And 100 rupees seems to be I mean, easy enough way to I mean, get through and get on with life. So if you look at it that way, I would say that let us not fret too much on this. Let us look at how we can allocate our money appropriately and get return and move ahead in life. So that is how I will look at it. So there is nothing much we can do about it. The impact is actually pretty less. So I would not really dwell too much on that, worry too much on that.
Okay, so it's not a point of worry for sure. Avinash, any different thoughts?
I agree with Suresh on that. I mean, it's not an issue really. I'm not a CA, and I think let's wait and see. But it doesn't move the needle for long-term investors.
Absolutely, absolutely.
So viewers, again, so many questions around this, and the best of minds are saying that please don't worry about it, because frankly, even if you worry about it, there's nothing you can do about it. It's correct. It's a government regulation, and you have to go ahead and kind of move on. Okay, fair call. Let's move on then. And the third one that we wanted to talk about, which is what we've kind of spoken about, and then I have a few other questions. But Avinash, I want to start off with you on this one, and that is this inter-scheme transfers. And I think it started off post Franklin, right, wherein one or two fund houses did those transfers. I think ICICI was one. We had called them as well, and they spoke about it. But the point being, I think the whole issue came into the spotlight post Franklin. Now, with the move that is being done or thought of being done, and I presume that it is now into effect as well, how does this alter the landscape, both from a fund perspective as well as from a perspective of somebody who's watching this or has watched in the past and said that, hey, why is this happening? And now is that kind of ring fenced? Do you have any thoughts here?
I see it in a big picture as SEBI is trying to have tighter governance and tighter control over everything. And I think in general, that's been a positive step. This particular issue doesn't really bother me too much or impact my clients and my kind of advice too much. I largely just recommend overnight funds and a subset of liquid funds, which hold mostly government treasuries. So for those products, it doesn't matter. For the rest of the products, it could have some small impact, but generally it should be a positive impact for people. And I think to the extent that it's really bothering you in your portfolio, then probably you've constructed a wrong portfolio if you have to worry about this issue really.
Yeah, well, and that point is well taken, Avinash, but a lot of times people also have legacy things. And to be honest, until this happened with a couple of large fund houses, nobody quite thought of second guessing what the impact of this could be, and which is why maybe there's a lot of chatter around this. Suresh, you want to dwell a bit on this?
Yeah, so I would agree that this is a very, very good positive news from the investor community is concerned. While the fund houses may have their reasons to transfer, one of them is to establish liquidity in a particular scheme. It can certainly affect other schemes, and we have seen that it has affected other schemes as well adversely. So the point is now, if they are putting certain end conditions on, if they are imposing certain conditions on at what point they can transfer and in what conditions they can transfer, I think it is all for the best. So I have gone through this, and it looks to be a very good step from SEBI side in terms of protecting investors' interest.
Anything from a mutual fund manager perspective, Suresh, that would be a bit cumbersome to manage, because you when an event happens, you kind of paint everybody with the same brush, right? That are ye ho gaya, so chalo, great, because funds won't be able to do it. But maybe some funds might have been able to use this flexibility in a good fashion. Maybe, I don't know, I'm asking you. And does that kind of reduce that, or you think that is not necessarily the case. And again, I'm not talking about the two safest categories, which is overnight or whatever, the most liquid categories, but the other ones.
I understand. So SEBI is allowing interfund transfers primarily to tackle such liquidity situations which may arise at any point in time. Okay. So they want to protect the investors' interest in the sense that, I mean, to just show a good picture in one fund or meet the liquidity, you should not penalize some other fund. So that is what they are trying to do. So if they are saying that you exhaust all other possibilities, and then you look at this interfund transfer, and it has to be transferred at an appropriate price. I mean, it cannot be that one fund is gaining something while the other fund is losing something. So it cannot be like that. And they have also ring-fenced this other issue that if there is a negative news circulating, or you feel through your internal credit mechanisms that I mean this particular paper should not be there, so you just are dumping into some other fund, kind of obscure from the fund house perspective. So that those things are not any longer permissible, and you cannot dump anything into a closed-ended scheme also. So these are very, very good steps from SEBI's side, and I think any good fund manager probably will anyway not do all these things, but only that this has now become law, and they will have to definitely follow this law in letter and spirit now.
Avinash, just wondering from a larger perspective, do you reckon that I mean, there is an argument that so many people make that let mutual funds and debt funds be a pass-through vehicle and not necessarily an investment in debt fund being the vehicle to earn that 1% extra. There's so many people who say that why is it that the fund managers are taking undue risks, quote unquote. I'm not saying funds have done that or not done that. I'm saying the argument is that a lot of people are saying that why are fund managers taking these undue risks for that 1% more, wherein all I want in my debt fund investment, primarily is for safety, and then maybe if that extra return comes, great. So do you think a whole spate of regulations that has come in ever since the SL move happened back in 2018 are making maybe funds more true to label, and maybe the debt category, and maybe the option of making abnormally high returns via the fund manager's genius a lot less possible?
Yeah.
Okay, maybe I'll just try and come back to Avinash when the connection is slightly better. Suresh, can I ask the same question to you? Avinash, sorry, I've got you on a very patchy line. Not quite. Okay, Avinash, maybe I have a line. Let's just give it a try again, and then I'll ask Suresh the same question. Can you repeat the answer?
Yeah.
I lost you completely.
I'll just repeat myself that I see debt mutual funds as a tax arbitrage mechanism for people in the high tax bracket. So if you're in a 30+% then it's pre-tax it'll earn you lower returns than FD, but post-tax it'll earn you higher returns than FD. Hopefully, we can't be sure. So that's the right way to look at a debt fund, as keep your money safe, and that's how at least I look at it. And from that point of view, I do not really want this extra yield on these debt funds. This could be my personal view, and hence I don't like credit risk funds, etc. I think by and large, most retail investors should be looking at it that way. And from that point of view, I wouldn't comment about true to label, but I think taking less risk is better for the debt funds. And I mean, I don't have any issue with that.
Yeah, sorry. So true to label might be a wrong thing. True to, how do I say it? The perception of what the funds should be doing. Let's put it that way. Maybe not the label.
Yes.
Yeah. Thanks for correcting me. Suresh, your thoughts here.
Yeah, I mean, I would kind of echo what Avinash had just now said. So we are not really looking at debt funds purely from the point of view of generating that 0.5% or 1% extra. While it is very much possible that a debt fund can potentially generate that 0.5% or 1% extra, as compared to what is typically available for a general investor, because there are so many vehicles which are available to qualified institutional buyer like a mutual fund, which is generally not available in the public domain. So there are possibilities of them actually striking a good deal with a good company, well-rated company, and they can potentially earn that 0.5%, 1%. I do concur with what Avinash told some time back, that even if it is more or less the same return or slightly higher return, on a tax-adjusted basis, it is generally better than a typical comparable vehicle of a similar credit quality. So the most important thing I would say is that as compared to most other vehicles, this is absolutely liquid, and you can be absolutely sure that you will get your money when you want the money. So that is, I think, the most important thing that I'm looking when I'm actually looking to invest in debt mutual funds.
Yeah, well, that's also a train of thought, right? And a school of thought, that why compromise with that, which is the first basic tenet of what this fund should be. But gentlemen, both of you, thank you for joining me today and giving us some sense of these 2 or 3 things which were well in the chatter for sure. Lovely having your views here, and stay safe, both of you.
Thank you, Niraj. Good day to you and good day to all the viewers.
Thank you so much. And viewers, thanks for tuning in to this leg of the Mutual Fund Show.